Good evening to you. Welcome to Wealth Quest. This, of course, is the show that helps you navigate the murky world of investment management. My name's Samantha. I'm coming to you from Cape Town. Now, focusing on our topic of the week, the focus here on the proposed Foreign Account Tax Compliance Act, that also known as FATCA, that's going to come into effect on the 30th of June 2014. Now, essentially what this is, it's legislation that's been brought on by the US government, that by the, of course, Internal Revenue Services Department to force other countries to report on US citizens' assets that are being held outside of the borders of the United States. Of course, this will have an impact certainly on US citizens, a direct impact there, but what impact will that have on citizens that aren't necessarily US residents? To help give us some insight into all of this, joining us from our Johannesburg studio, we've got Anthony Markham. He's a partner at Maitland. And then sitting beside him, we've got Cobie Legrange, who's from ClucasGray Investment Managers. Welcome to you both, gentlemen. Let me try and control the conversation from Cape Town here. Anthony, just to start off with, give us some impact or give us some assessment on the origins of FATCA, essentially.
FATCA was introduced by the US because US citizens, unlike most people in the world, are taxed wherever they happen to live in the US. As a result, the US feels that it has the right to information about worldwide assets of US citizens, and indeed US citizens have to report. For some reason they thought that perhaps the secrecy jurisdictions, the international financial community wasn't directing the information the way back to South Africa the way they should, and so they introduced FATCA, which is a worldwide information collection and reporting machine which has been imposed on the world by the US.
I mean, and I suppose, Anthony, one of the questions that kind of come to mind here is this really different to what we had previously? I mean, previously, if you were a US citizen and you had assets outside of the borders of the United States, you kind of, did they rely on your kind of good faith in order to kind of tell them about the assets? Is this, was there no mechanisms in place, or are we talking here about something that's completely different to what we had previously?
It is different. It's different in two ways. First of all, of course, there were mechanisms in place. US citizens, FATCA does not introduce any new obligations on US citizens, apart from an extra form they have to file with their tax return. But it's the same information as they filed before. The new thing, though, is that automatically the information will be about the international holdings will be made available by the financial industry worldwide to the US government, and so there will be no place to hide. This automatic reporting of information increases compliance enormously in all sorts of areas of life. The second thing is that the actual sort of reporting which is being introduced is different in nature to the sort of reporting that's ever seen before. So, for example, trusts and trustees historically have had very few reporting obligations direct. Now, for the first time, trusts will be feeding into this machine information about beneficiaries. Companies owned by US citizens under FATCA will be feeding information directly into this system, and that's new.
Mm-hmm. You're looking at two parts, it seems. So you've got feeding of information, that automatic exchange that you're talking about between revenue services, say from the South African Revenue Service to the IRS. And then you've also got a compliance issue from taxpayers here in South Africa who have to disclose perhaps more information. So talk to us about the one part there where you have to have those kind of that feeding mechanism in place between revenue services. Is that mechanism in place right now? I mean, where are we in terms of that being established?
I mean, there's a technical answer which I won't spend time on about how information is legally conveyed between governments. But the interesting thing is that as a result of the US government's initiative, they have forced all the world's financial industry to build this reporting machine. It's like a car. You don't need to know how it works. And in fact, the way FATCA is designed is very technical and very detailed with its own jargon, and it's horrible to have it explained to you, so I won't even try. But the car, once it's built, anybody can drive it. And the second crucial thing to realize about FATCA is it's been forced on us by the US. I didn't tell you quite how it's forced on us, but it has been. It is now a machine that can be driven by any government that wants to pick it up and use it.
I mean, one of the questions that kind of come to mind here is that, not complying with this has got some fairly large implications for individuals and for trusts and so forth. As a matter of fact, if you look at your screen quickly right now, we've got a visual that I'd like to show you. And there you can see just a little bit about FATCA. It's an international data collection mechanism, US-inspired, enforced by a 30% withholding tax. And that's what I spoke about just now. Not complying with this means that you'll have a 30% withholding tax on capital, interest, and various other things. And then it's extended by intergovernmental agreements. And as you can see by the next one there, you can see, really speaking, we're talking about G5, G8, and G20 and OECD potential extensions, and South Africa being fully engaged in this. Now, I mean, South Africa is part of a pilot program at this stage, rather than it being enforced by the IRS at this stage. So South Africa, tell us a little bit about that pilot program. How did that come about?
What's happened is two things. First of all, the US said we're going to impose a 30% withholding tax on any financial institution that doesn't comply. Governments looked at that, financial institutions looked at that. The financial institutions told their governments, we can't comply actually, we need your help. So the governments intervened, in fact, to ease the way for US FATCA by entering into the intergovernmental agreements. That was the first thing that happened. And that meant that each government, as it worked through this process, became very familiar with the reporting engine. What happened next was that, as I said, other countries started to jump onto the bandwagon. So first of all, the UK, very much in the forefront here, imposed FATCA on its offshore territories like the Isle of Man, where I happen to live. One reason why I know so much about FATCA. But after that, this has been very much a hot topic in the international community. After that, the G5 first said that they were going to use this FATCA engine to promote transparency, tax transparency between themselves. The G5, that's the UK, Italy, Germany, Spain, and France. That pilot is the G5 pilot. It was endorsed by the G20. It was the G20 also gave some sort of mandate to the OECD to make this all happen. Most recently, and this for me was something which I suppose I expected it sometime, but not so soon. On the 13th of October, South Africa announced it was joining the G5 pilot, along with other countries. But that means that South Africans their government has effectively committed themselves to collecting and exchanging with all the parties to the G5 pilot tax information, which means that all the information from obviously the US, but also the UK, France, Germany, Italy, Spain, but perhaps more, I don't know, perhaps there might be greater vulnerability, also from the offshore jurisdictions, so Cayman, Bermuda, Bahamas, the Isle of Man, Jersey, Guernsey. All these information will be reporting back under the pilot to South Africa.
Now, Anthony, let's talk about what this means for South African taxpayers, because I would assume there are a lot of people who have money offshore. Some perhaps is saved in areas where they might not want the tax authorities to have a window onto into these assets. But the bottom line is, if you do have offshore assets, you need to start to think about how these will be seen by the local tax authorities and reporting this ultimately into the FATCA mechanism. So talk to us about what needs to be considered by South African taxpayers who do perhaps have money sitting offshore that they're a little bit concerned about how tax authorities have viewed it in the past.
Well, of course, very many South Africans took advantage of the amnesty, and so a large number of them will be compliant and will have no real issues here. The South African tax authority will have a different perspective, perhaps, because they get reporting on account balances instead of reporting on distributions, which were in the historical thing. So for the compliant people, it's how will this influence the tax authorities? But if anybody is non-compliant, I would, I see relatively few of these, but if anybody is non-compliant, I would seriously recommend them to do something about it now. And if they sort things out by approaching the tax authorities, that will put them in a much better position to get what I might call an acceptable settlement with the tax authorities than they will be if they go through the trigger dates for reporting and find themselves being reported on, and the taxman knocking on their door instead of them knocking on the taxman's door.
I suppose one of the questions that come to mind here is, and again, I'm not a lawyer, I'm not really speaking from a fund management perspective, but surely, you know, a lot of people would argue that there's privacy of information at play over here. Or does this, what we call the intergovernmental agreement, ready to put FATCA into motion, does it supersede that? Is there something that kind of constitutionally people could say, well, look, or governments could say, look, you don't really have, this is not really private information?
It's very difficult, if it's relevant to your tax return, to say the information is private. In other words, so the sort of the constitutional argument may not have much legs. Having said that, some of the information collected by FATCA is not directly relevant in all the countries which is collected for to tax returns. And there is indeed a human rights case to say that too much information being collected, that there's a real danger that this information will be collected and be used in ways that we don't even know now, through data mining, through putting things together in the way that machines can do now, in ways that may in fact have a human rights implication. There are in the US, there's quite a movement to say FATCA is the worst law ever. The international finance industry has had to do an awful lot of work, is going to have to do an awful lot of work to put it in place. It indeed is very intrusive and unpleasant legislation.
And Anthony, just before we end off, very quickly, do you think that this marks the end of offshore investing, and specifically in jurisdictions that sell themselves with that unique selling point of course, offering some privacy to investors? I mean, what future does this mark for offshore jurisdictions?
The offshore jurisdiction's real selling point, the real USP is not secrecy. The real USP is being tax neutral. So you can go to an offshore jurisdiction, you can set up your structure for collecting investments and reinvesting them elsewhere in the world without having to worry about additional tax complications arising from that. Tax neutrality and, frankly, expertise is what we must sell. Secrecy, obviously privacy is something which people need, but secrecy is not something which is available vis-a-vis the tax authorities in future.